Welcome to the latest edition of International Tax News. I'm Doug McConey, PwC's International Tax Services Global Leader. In this edition, we cover selected tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in depth on similar topics, check out the Cross Border Tax Talks podcast in video on YouTube or in audio wherever you find your podcast. Now turning to our current edition. First, the UAE has implemented a domestic minimum top-up tax, effective for financial years starting on or after January 1st, 2025. The DMTT rules provide details for calculating the top-up tax, scope and conditions for covered taxes, accounting standard requirements, various exclusions, certain administrative and compliance matters, and liability provisions. Broadly, the DMTT rules align with the Globe Model rules. There is no clarity on whether the UAE will introduce an income inclusion rule and/or undertax profit rule, the other charging mechanisms under the Globe rules. Next, the French finance law for 2025 was published in the official journal on February 15th after an unprecedented 7-week delay. The most significant corporate tax measures adopted are an exceptional corporate income tax surcharge and a tax on share buybacks. The exceptional CIT surcharge applies to the first fiscal year ending on or after December 31st, 2025, and will be based on the average corporate income tax owed over a 2-year period. The surcharge rate will be 20.6% for companies with an annual French turnover between 1 billion euro and 3 billion euro, or 41.2% for those with 3 billion euro or more. Finally, President Trump on February 1st signed 3 executive orders announcing his intent to impose 25% tariffs on imports from Canada and Mexico and a 10% additional tariff on imports from China. The tariffs were set to take effect at 12:01 a.m. on February 4th under the authority of the International Emergency Economic Powers Act. Following talks with the leaders of Mexico and Canada, however, President Trump said he would pause implementation of tariffs on imports for those countries for 30 days. The executive order for China took effect as scheduled. President Trump's newly announced tariffs are expected to have significant implications, including higher prices for consumers, supply chain disruption, and escalated trade tensions with the U.S.'s biggest trading partners. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition and on the next episode of the Cross Border Tax Talks podcast.